Welcome to Tax Insights, presented by Hawkins Ash CPAs.
Good morning, listeners. Welcome back to Tax Insight here on the Lakeshore's Good Neighbor, WOMT. We got Jeff with us this morning. Jeff, good morning, sir.
Good morning, Terry.
We're talking about the tax impact on receiving an inheritance.
Right, because as the baby boomers continue to get older, we're seeing that a wealth transfer is happening between this generation and the next generation. Now, the number one question that I get from survivors is how is this going to affect them from a tax point of view? So, let's start at the beginning. When a person passes away, their assets have to be used to pay off any debts that they have, any of their liabilities. And whatever is left, that's the part that can get inherited by others.
Now, I have heard that if you receive an inheritance, you do not owe taxes on that. Is that correct?
Yeah, that's generally true. And that's true for things like assets or some after-tax investments, real estate, vehicles, personal items, things like that. But it's actually not true for IRAs, annuities, and other retirement accounts.
So why is that different? Why?
Yeah, because in Wisconsin and many other states, they have what's called the step up in basis. And you don't get a step up in basis for IRAs, annuities, and retirement accounts. Now, the reason why you don't get that step up in basis is because, when you put money into a retirement account or into an IRA, you actually get a tax deduction for that. So you never paid any tax by putting money into it. So at some point, somebody's got to pay the tax for those type of assets.
So let's back up a moment and explain what is a step up.
Yeah. So no matter what the asset costs, what the step up does is it takes the fair market value at the date of death, and that becomes your new cost basis. So it doesn't matter what the person paid for along the way. It's worth whatever the fair market value is at the date of death. So for a lot of states, what that means that you're not going to have any gain. So that would be for, like for homes, investments, things like that, where, they would have had a gain if they passed away or if they sold it the day before they passed away. But if you sell it the day after you pass away, there generally is no gain. Now that works for Wisconsin, but there are certain states where you only get kind of a half step up. So you still get a tax benefit. It's just not as good as in a community property state like Wisconsin.
Okay. So what about life insurance proceeds?
Yeah, so life insurance proceeds, they're tax-free. So that's good news.
So then what about income earned on the asset after you received it?
It's taxable, just like any other asset. So let's say that you have an investment and it got a step up in basis to $100. And now you sell it and it's worth $105. You still pay tax on that $5 extra. Now, knowing the rules for inherited property is really going to help you to be able to ask the right questions when you get your tax return done at the end of the year. So that's why, we definitely suggest if you get an inheritance, talk to a tax professional.
Absolutely. Jeff, great information for our listeners this morning. How do listeners connect with the team at Hawkins Ash?
You can go right to our website, which is hawkinsash.cpa.
And we'll talk to you next week here on WOMT.
This has been Tax Insights, presented by Hawkins Ash CPAs. Learn more online at hawkinsashcpas.com. Hawkins Ash CPAs, part of your business, part of your life.